Here's the brutal truth about market crashes that no one teaches you. A 50% drawdown requires a 100% gain just to break even. Most traders never recover. While amateurs chase the next hot stock tip, professionals focus on one thing: subtraction, subtracting big losses from their future. This mathematical reality destroys more fortunes than any single market event ever could. Jesse Livermore survived the 1907 panic and the 1929 crash that wiped out millionaires overnight. His secret wasn't predicting crashes, it was preparing for them. The man who made millions while others lost everything understood that your edge isn't prediction, your edge is preservation. He treated waiting as a position, read the tape for pivotal points, and never married a view, only risk rules. Picture two traders in October 1929, each with $100,000. Amateur trader John puts 50% into sure thing stocks, convinced he can ride out any storm. Professional trader Sarah risks only 2% per position across multiple uncorrelated trades. When the crash hits, John's concentrated positions drop 60% in 3 days. His $50,000 becomes $20,000, a devastating 30% portfolio loss from one bad decision. Sarah's diversified 2% positions. Even if half go to zero, she's only down 10% total. More crucially, she has capital left to capitalize on the chaos while John sits paralyzed by his losses. The difference isn't intelligence, it's identity. Amateurs protect their opinions, professionals protect their equity. They understand that position sizing isn't just risk management, it's psychological management. Small positions keep you calm during market storms. Calm traders make rational decisions. Rational decisions compound into consistent profits over time. Livermore's complete blueprint defied conventional wisdom: position sizing that preserves sanity, stop losses that save fortunes when hope becomes dangerous, the waiting game that separates winners from losers, and the pyramiding secret that builds wealth without courting ruin. Over the next chapters, you'll learn his exact survival protocol that kept him solvent when panic ruled the streets. But here's the hidden truth that will shock you. Sometimes the best trade during a crash is no trade at all. If you can't take a small loss, you will take a mother of a big one. Livermore's maxim cuts clean through every amateur's delusion about going big to win big. The smaller your position size, the larger your account grows over time. Sounds backwards? That's because amateurs think about potential profits while professionals think about probable losses. This psychological shift separates survivors from casualties in every market crash. Here's the protocol that saved Livermore's fortune. Never risk more than 1–2% of your total capital on any single trade. Let your stop loss dictate position size, not your greed. Elena follows this rule religiously with her $250,000 account, risking exactly $2,500 per trade. When her biotech stock gaps, down 15% on failed trial results, she exits immediately. It stings, but she loses only 1% of her portfolio. Her account remains intact, her psychology unshaken, her future trades uncompromised. Her friend Marcus bought the same stock with 20% of his account and no stop loss, convinced he could ride out the volatility. The 40% crash that followed wiped out 8% of his entire portfolio in one devastating trade. Elena can make 100 more trades before facing Marcus's single trade devastation. She stays in the game while Marcus sits paralyzed, nursing wounds and regret. Position sizing isn't just risk management, it's psychological management. Small positions keep you calm during market turbulence. Calm traders make rational decisions. Rational decisions compound into consistent profits. When you risk only 1–2% per trade, you can afford to be wrong repeatedly without destroying your future. The amateur asks, "How much can I make?" The professional asks, "How much can I afford to lose?" This mathematical approach seems conservative until you realize its power. With proper position sizing, you need only 51% winners to profit long term. Without it, even 70% winners can bankrupt you if the losers are too large. Livermore understood that preservation of capital isn't defensive. It's the ultimate offensive strategy. Big bets are loud, professional money whispers. But position sizing is just the foundation. The second rule is where most traders break, even when they get sizing right. It's about what happens when your carefully sized position starts moving against you and hope begins clouding judgment. Livermore's second survival principle sounds deceptively simple. Honor your stops without negotiation. But here's what separates amateurs from professionals: execution under pressure. The amateur sets a 10% stop loss, then moves it to 15% when hit. Just a little more room, they rationalize. The professional sets a 10% stop and executes it like a machine, without emotion, without hope. This mechanical discipline kept Livermore solvent when others went broke. In 1907, Livermore held Union Pacific at $162 per share. His stop was set at $145, exactly 10% down. When the stock touched $145.50, he was already preparing to sell. At $145, he was out completely. Union Pacific eventually collapsed to $85, a devastating 48% loss he never experienced because he honored a simple 10% rule. While other investors rode their temporary setbacks into permanent losses, Livermore preserved his capital for better opportunities. The psychological trap is seductive. Hope feels better than accepting a small loss. The amateur thinks, if I just hold on, it might recover. The professional thinks, if I cut this loss now, I preserve capital for the next high probability setup. This isn't about being right on every trade. It's about surviving every trade. Your job isn't to predict market direction. Your job is to be wrong the right way. Here's the protocol that saved fortunes. Set your stop at a logical, technical level below support for longs, above resistance for shorts. Write it down before you enter the trade. Never move a stop away from your entry price. That's financial suicide disguised as patience. Honor it mechanically, like a machine processing data. Remove emotion from the equation entirely. Size your position so the stop loss equals exactly 1 to 2% of your total capital. Livermore's maxim echoes through time. Your first loss is your best loss. The market will take care of itself, but you must take care of your capital. Every professional trader has stories of small losses that saved them from catastrophic ones. Every amateur has stories of small losses that became large ones because they couldn't pull the trigger. The difference isn't intelligence or market knowledge, it's the courage to admit when you're wrong quickly. But cutting losses is only half the equation. What happens when you're actually right and the market starts moving in your favor? That's where most traders sabotage themselves in entirely different ways. Here's Livermore's most counterintuitive principle. Sometimes the best position is no position at all. While amateurs feel compelled to always be in the action, professionals understand that waiting is a position, often the most profitable one. Cash doesn't fluctuate. Cash doesn't gap down overnight. Cash preserves opportunity for when the odds truly favor you. But when the waiting ends and you finally act, how do you scale in without destroying yourself? Consider March 2020. COVID crashes markets 35% in 5 weeks. Amateur Mike sees bargains everywhere and deploys 50% of his capital at the first 10% drop, 75% at 20% down, fully invested at 30% down. He's averaging down into weakness, throwing good money after bad. Professional Lisa does nothing. She waits for confirmation, not just a bounce, but sustained strength above key resistance levels with volume backing the move. When Lisa finally acts, she starts small, 2% of her portfolio in a single position. As the market proves her right by breaking higher with conviction, she adds another 3% position. Strength begets strength. This is pyramiding correctly, adding to winners, never to losers. Mike is trapped underwater, watching his bargains become disasters, while Lisa rides the recovery from superior entry points with expanding size as profits accumulate. Livermore's protocol was surgical. Start smaller than you want. Add only when price moves your way with volume confirmation. Use rising stops to protect profits as you pyramid. Never average down. That's feeding fear with fresh capital. Only pyramid up. That's feeding proof with additional risk. The amateur asks, what should I buy? The professional asks, should I buy anything at all right now? This waiting game requires immense psychological discipline. You'll watch opportunities pass. You'll feel left out during rallies. You'll question your inactivity, while others seem to profit. But remember, every professional trader has made more money from trades they didn't take than from trades they did. Patience isn't passive, it's the most active position you can hold. But even perfect position sizing, flawless stop losses, and disciplined pyramiding can fail if you can't master the enemy within. The market is external chaos, but your mind creates internal chaos. That's the final battlefield where fortunes are won and lost. You can have perfect rules, flawless entry signals, and disciplined exits, but if you can't control the battlefield in your mind, you're destined to fail. During crashes, fear screams, "Sell everything," while greed whispers, "Buy the dip." This psychological warfare destroys more traders than any market downturn ever could. The enemy isn't the market, it's the voice in your head that convinces you to abandon your proven system when you need it most. Even Livermore wasn't immune to this final trap. In his later years, he let emotions override his proven system. He held losing positions out of stubbornness, entered trades from impatience, and eventually lost his fortune to the very psychological demons he once conquered. The man who survived multiple panics was ultimately defeated by his own mind. His tragedy teaches us that markets change, but human nature remains constant. Your greatest opponent isn't the ticker tape, it's your own psychology. The protocol for psychological mastery is rigorous but essential. First, develop a written trading plan and follow it religiously. Write down your position sizing rules, stop-loss levels, and entry criteria before markets open. This plan becomes your anchor when emotions rage and logic abandons you. Second, cultivate complete detachment from outcomes. View each trade dispassionately, like a scientist observing data. Your goal isn't to be right about market direction, it's to execute your process flawlessly regardless of results. Third, journal everything, not just profits and losses, but your emotional state during each decision. When did fear creep in? What triggered your worst decisions? This self-awareness becomes your shield against future mistakes. Practice position sizing until it's automatic. Rehearse stop-loss execution until it's mechanical. Make waiting feel natural, not anxious. Livermore's complete blueprint stands eternal. Cut losses fast at predetermined levels. Size positions small to preserve sanity. Wait for confirmation before acting. Pyramid only into strength. Master your mind above all else. The amateur trades with hope and fear as constant companions. The professional trades with process and discipline as their only guides. Remember that hidden truth from our opening. Sometimes the best trade during a crash truly is no trade at all. When the next crash comes, and it will, you won't be a victim of circumstances. You'll have a blueprint for survival. The blueprint is complete, but knowledge without execution destroys more traders than market crashes ever will. You now possess Livermore's 5 survival principles that kept him solvent through history's worst financial panics. Cut losses fast at predetermined levels, size positions small to preserve sanity, wait for confirmation before risking capital, pyramid only into strength, and master your psychology above all technical considerations. These aren't suggestions, they're survival requirements in a market that shows no mercy to the unprepared. Here's the harsh reality. Most traders will read these principles, nod in agreement, then promptly abandon them when real money is at stake. They'll convince themselves their situation is unique, that this time the rules don't apply. This is exactly how the market separates amateurs from professionals. Amateurs make exceptions to proven rules when emotions run high. Professionals follow their system religiously, especially when it feels uncomfortable to do so. The next crash is inevitable. Market history guarantees it. But here's the counterintuitive truth Livermore understood. The greatest fortunes aren't made during bull markets, but during the brutal wealth transfers that occur in crashes. While others are decimated by massive positions and stubborn hope, the disciplined professional sits with preserved capital and a clear process. They wait for genuine confirmation, not just bounces, but sustained strength with volume backing institutional buying. Start implementing these principles now, while markets are calm and emotions stable. Practice position sizing with small amounts until it becomes automatic. Set stops and honor them without negotiation. Learn to sit on your hands when no clear opportunity exists. These habits must be ingrained before you need them, because when panic strikes, you won't have time to think, only to execute. Remember that mathematical reality we opened with. A 50% drawdown requires a 100% gain just to break even. Most traders never recover from that hole. But with Livermore's blueprint, you'll never dig that hole in the first place. You'll take small, manageable losses that preserve your future while others chase their opinions into oblivion. When the next crash arrives and headlines scream about market devastation, you won't be asking, "What do I do?" You'll be executing your proven process with machine-like precision. You won't be a victim of circumstances beyond your control. You'll be a survivor with capital intact, ready to capitalize on opportunities that chaos creates for the prepared mind.